Have yields peaked for this cycle?
Yeah, we think there's a pretty strong likelihood that that 4.25 to 4.33 that we got last October is the peak of the cycle. But really can't rule out the TADs going back up and testing these higher levels because the Fed continues to hike. So you have to sort of guess how deeply inverted the yield curve will be. We don't think it gets a lot more deeply inverted than minus 100 or so. So that probably puts the downside at a higher level than we had previously anticipated. But I think the peak has probably been seen.
Kathy, what's more important from your perspective? The rates are going higher at the Federal Reserve, or this cycle is lasting longer?
I guess it's that the cycle has lasted longer. I mean, I think it's important that the Fed continues to signal that they're going higher, and that means, further and further weakness down the road. But the longer they hold, the more that, in my opinion, risk of some sort of market accident or some sort of, economic accident. So we already had the banking incident, as Paul called it, in March. And I think the longer the Fed stays on hold, the higher they go, the more risk there is that we see other market incidents that take place.
Beneath the surface, Kathy, do you see something similar that I'm hearing from Megan Robertson over at BNP Paribas, that their study of bankruptcy filings for smaller, mostly private companies is showing a default cycle is underway?
Yeah, we are seeing the same thing. So those bankruptcy filings are up pretty sharply. And we've been concerned about the private credit markets for quite some time, simply because there hasn't been sort of a mark to market, right? A moment of reckoning where they've had to come in and say, okay, well, that's, we're going to write things down. They're starting to write things down, but we haven't seen it actually happen yet to the full degree or realized in the public markets. So we do think that as you get the student loan payments coming back online, you're seeing a lot of trouble with financing now in the auto sector. Credit card charge-offs are picking up. Bank lending standards are tightening. All the components you need for some sort of at least a mini credit crunch or deterioration in high yield are there. They just haven't panned out yet. Maybe because a lot of companies have termed out their duration for another year or two.